Ladies and gentlemen, good day and welcome to Shankara Building Products Limited Q4 and FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sukumar Srinivas from Shankara Building Products Limited. Thank you, and over to you, Mr. Srinivas.
Good afternoon, everyone. I extend a warm welcome to all of you on behalf of Shankara Building Products Limited for this earnings call of Q4 and for the financial year 22-23. I have with me Mr. Alex Verghese, our CFO, and Mr. Dhananjay Srinivas, who is the Vice President Business Development, and our Investor Relation Advisor, Strategy Growth Advisor. I hope all of you must have had a chance to look at our investor presentation that is uploaded on the stock exchanges. Let me straight away get into the industry dynamics and business scenarios in the Q4 of the financial year ending FY23. In FY2023, building sector, material sector has experienced a consistent growth and business expansion. The thrust in infrastructure development, coupled with the uptake in real estate demand, helped the industry to bounce back strongly to the pre-COVID level. Demand for new building and redevelopment projects has risen in both the residential and the commercial sectors. People's preferences have shifted in the last 2 years towards larger homes and changes in architecture and interior design. People now understand the value of having a better equipped home and better lifestyle, thanks possibly to the pandemic. Additionally, every indicator shows that India is performing well on the global stage and has strong economic growth. An advanced Indian today who resides in any major metropolis wants to give his family and himself a high quality of life. All these reasons have led to a significant increase in the demand for building material products, particularly in our key markets. We believe on a macro level, due to the government's emphasis on capital spending, improved capacity utilization in manufacturing, a double-digit credit growth, and moderated commodity prices, manufacturing and investment activities are anticipated to increase in the economy. The building material industry is predicted to be strong in FY24 due to all these factors and the government's sustained focus on expanding infrastructure, low-cost housing, and rural housing. Coming to the company's financial performance, I am happy to share that our performance in FY23 has been consistent and strong. On the back of a recovery in the entire home improvement industry, our top line increased by 67% in FY23. Consistent efforts have been taken over the last few years to strengthen our balance sheet, and that has also yielded good results. We have received tremendous response from the market and customers, clearly indicating that customers are looking for a one-stop solution for all building materials. We aim to make home building easier for our customers. Our SSG for the quarter ending of FY23 stands at 53.5%. We have witnessed higher footfall in retail stores and experienced an improved trajectory in the online channel. Overall demand scenario was supportive. Our efforts over the last few quarters helped to improve our working capital position. Our working capital cycle for Q4 came below 1 month, and the net operating cash flow for the year was at 92 crores. Our strong performance is a reflection of our well-defined strategy, which is supported by the power of our most valuable assets, our people, and our approach to our execution. We not only successfully navigated the immediate challenges, but also significantly advanced our long-term strategic aim. In addition to sticking to our long-term profitable growth strategy, we strive to differentiate ourselves through innovation, a strong retail presence, quality products, and high standards of customer service. We continue to aspire to grow our top line by 25 to 30% in FY24. We are also working hard to improve our profitability. A quick update on our various business segments. Retail business continues to perform well and continued to perform well in FY23. We have seen a good uptake in retail activity throughout the year. As stated, we have achieved a strong SSG for the quarter and for the year. Our non-retail segment, which constitutes our channel and enterprise business, has also performed consistently throughout the year and has been quite resilient. We are optimistic on the upcoming demand scenario for the coming financial year, that is FY24, across all our businesses. I will now ask Dhananjay to give you a brief update on the building materials retail segment.
Good afternoon. I would like to begin with a quick overview of the products in Shankara's building material life cycle. As you might be aware, Shankara supplies materials starting from TMT, cement and construction chemicals, to plumbing, sanitary ware and fittings, to tiles, adhesives and flooring, to electricals, lighting and paints. We have modular kitchens, hardware, related appliances, and of course our legacy products of MS tube, structural steel and roofing. Over the last year, we have seen a good growth from the non-steel segment. There has been an increase in retail walk-ins and we feel our brand equity has grown. We have maintained a good growth in CP fittings and sanitary ware, and the focus for the coming year is a substantial growth from our tiles, electrical and lighting verticals. In FY23, we did a total turnover of rupees 361 crores of our non-steel products as compared to 200 crores in FY22, registering a growth of around 80%. In the last quarter of the previous year, we successfully launched our Build Pro app on Android and iOS. We have seen a good response from our customers and we have become a discovery tool for customers before they walk into our stores. We have also seen an 18% increase in traffic on our e-commerce website and are working towards adding more verticals. We have clocked in an average of 80 lakhs per month of online sales in the last 6 months, and we are working on improving our online presence in the year ahead to reach more customers through our digital presence. We continue to utilize technology to improve our customer acquisition and retention. We are working towards customer transparency in the building material life cycle. We believe customers and influencers need more clarity and visibility towards the ever-changing building material industry. And we here at Shankara work with a customer-first approach to enable that ease of business. Our tools help customers view all the stages of construction, view all the brands and all the materials per stage, plan their purchases ahead, and plan a complete BOQ for their home. This puts the control back in the hands of the homeowners. Our stores pride themselves on product knowledge and we utilize technology to share this knowledge with our customers. We help them understand the best products for their needs. Our customer-first approach rewards customers for loyalty and offers them choices and prices unmatched in the market. This year, we are launching 2 exclusive ultra-luxury displays in Bangalore and Chennai that aim to cater to our premium customers, offering them superior brands like Hansgrohe, Duravit, and other specialty products imported from Italy. Shankara is very focused on growing the non-steel business. We are working towards achieving 20 to 25% of our total volumes in this vertical in the next 4 to 5 years. Thank you.
Now, I will request our CFO, Mr. Varghese, to talk about the financials.
Good afternoon, everybody. In Q4 FY23, our total revenue stood at rupees 1,210 crores, registering a growth of 54% vis-a-vis the corresponding period FY22. Q4 FY23, EBITDA stood at rupees 36 crores, which was 3.03% and registered a growth of 16% compared to Q4 FY22. PAT was at rupees 19.1 crores as against 15.5 crores in the same quarter for the previous year. For FY23, our total revenue came at rupees 4,029 crores, registering a growth of 67% as compared to the previous year FY22. EBITDA was at rupees 125 crores, which was grown to 42%, and the margin came at 3.1%. PAT was rupees 63 crores as against 34.3 crores in the previous year. The Board of Directors have recommended final dividend of rupees 2.50 per share, that is 10% of Shankara standalone PAT amount for the year ending 31st March 2023, subject to the approval of the General Body. We have considerably reduced our debt level, and at Q4 end, we are at a comfortable net debt position of rupees 70 crores. In FY23, our return ratios have improved. For FY23, ROCE stood at 15.03%, a substantial improvement over the 10.4% achievement in the previous year. We are confident of improving our return ratio in the coming year. Thank you for your kind listening. We will be happy to answer any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Nisar Vakharia from NV Alpha Fund Management. Please go ahead.
Good afternoon, gentlemen. My first question is that in the working capital management side, we are at probably the lowest, utilization of working capital over the last few years. Just wanted to understand how sustainable is this number?
We believe it is quite sustainable, so we hope to keep it in that numbers of around 30 days overall.
Okay. Second question is that essentially our revenues have ramped up, with the same square feet across few states. What is the maximum revenue that we can do on the existing infrastructure of 90 retail stores?
We believe that we can definitely add even in the current year. I'm talking about FY24. So I think we can manage with our existing square footage, probably with a marginal increase. We are planning about 2 to 3 stores addition in this coming year. So with the marginal increase, we can manage with the same square footage that we have.
Okay. And my last question is that if I heard it right, you said that the non-steel products sales is about 360 crores in this year. Did I hear that right?
Correct.
Okay. My question is that what is the difference in the gross margin of selling steel products versus non-steel products?
So the steel product will be the gross margin of around 3.5 to 4%, wherein non-steel it will be around 10% on an average.
You're talking about EBITDA, sir, right?
No, we're talking about
gross margin. You're talking about gross margin.
Yes.
Okay. And we saw fantastic growth Y on Y. However, it's come at a slight, margin impact. So what is the base case margins that we should assume for FY24 for our business?
See, there is, last year we did go all out on the top line growth. We had to get out of the terrible two, so to speak. So we did power our revenue growth immensely. So we had also talked about and directed around 3.5%, like 2.5 to 3% was our talk on EBITDA last year. This year, definitely, we hope that anywhere between half a percentage point to 1% is what we are looking to see whether we can improve the EBITDA.
Okay, great. Thank you so much, and all the very best for FY24.
Thank you.
Thank you. Next question is from the line of Aman Soni from Prudent Equity. Please go ahead. Aman, may I request you to unmute your line from your side and go ahead with the question, please?
Hello, am I audible?
Yes.
Hello. Yes, we can hear. Yeah. So my first question would be, for the FY23, how much, sales we did with the, APL partnership?
Hello, sorry?
Hello? Hello?
Yes, Aman, you're audible.
Yeah. So I wanted to know
Can you repeat that question, please?
What was the revenue for FY23 with the, APL Apollo Tubes?
Apollo Tubes was around close to around 40+%.
40+%. And,
Yeah.
in volume terms, how much would that be?
Around 1,600 crores approximately.
No, I mean in terms of the, volume of the product in metric ton.
Oh, volume. Okay. It will be in the region of close to, I'll just tell you the number. Just give me a moment. It's about 2.4 lakh tons for the whole year.
4 lakh tons for the whole year. And what are we, targeting for the next year, FY24?
We are more or less looking at very similar figures as far as the APL Apollo goes.
Okay. So basically, one thing is, based on the historical financials, if I can see, or, for the past 2-3 years, your run rate was around, 2,000 crores only. And for the, FY23, I believe this entire growth, came from most probably APL only. So how is the, other business doing, X of, APL Apollo? Are there any kind of, growth opportunities or any new initiatives there?
Yes, phenomenal growth opportunities are there. That's why we've already held the APL Apollo more or less on the same ground. So if we are looking at even a 25%, let's say, a top line growth, the APL Apollo would probably remain at the same number.
Okay. And any kind of, other tie-ups similar to APL Apollo planned in the future?
Sorry, any other?
Any other type of, similar tie-ups which we have currently with APL Apollo Tubes? With any
No, nothing is really envisaged this year, no.
Okay, all right. Now, my last question would be, basically on the, finance cost. So in FY23, I believe your finance cost, your gross debt has, come down quite a bit, but there hasn't been, any reduction in the finance cost. So forward, based on, I believe your current debt is around 80-90 odd crores.
Yeah.
So
in FY23, what is that?
Yeah.
In FY23, overall rate of interest, there was some increase was there. That was the reason that the finance cost, even though we have reduced the total borrowing, the finance cost was almost remaining the same.
Okay, so any specific reason why it was the same, and what is it's going to be, in the next financial year?
Next year, it should be anything between 24 to 30% between, because we are looking for a total top line growth of around 25%. So we are projecting something between 24 to 30 crores.
So here, basically for the coming year, the interest cost will be around 24 to 30 crores.
Yes.
Okay. So what will that, constitute? Because, 24 to 30 crores of, interest cost is quite high on a 90 crore debt.
Yeah, on 90 crores of debt. Yes, there are some portion of acceptance also we are bearing the interest cost.
Mm-hmm. So what would be the other part?
Acceptance or channel finance.
Okay, all right. No issues. I'll, join back in the case.
Yeah.
Thank you.
Thank you. Next question is from the line of Nikhil Chandak from JM Family Office. Please go ahead.
Yeah, hi. So, couple of questions I had. One is, the store count has been, or the retail count has been fairly steady at around that 90, 91, outlets. So, when do you finally press the expansion button and kind of take this higher? And whenever you do it, would your focus still be South India, or finally is the eventual plan to make this like a pan-India, retail, platform?
Right now, the focus is very much South India. We also believe, as I've mentioned earlier, that we do have scope to further expand in South India. So as of now, for the next couple of years, we're not really looking at moving beyond our, let's say, comfort zone. But having said that, I think the online platform that is there certainly gives a much better reach, which expands towards other geographies. So there is, as we had mentioned in the opening speech, there is a focus to try and gain greater momentum. Currently, of course, the turnover from the online platform is not significantly high, but we really hope to promote that in a big way and look at, reaching out to other centers using the online platform for the current, or maybe for the next 2 to 3 years.
Understood. So would the retail count remain similar over the next couple of years?
I mean, we are talking of, a plus minus 2 to 3. I mean, it's not going to significantly change.
Understood. So, but with this existing retail count, like for example, you've done close to 67% growth in top line, I see, in fiscal 23 over 22. So, with the same retail count, I think you answered margins could be probably maybe 1% higher, but what can be the top line, growth which comes in from the similar retail count?
See, we are currently at around, when we look at the breakup of our retail and the non-retail, I think in the last year we were at broadly around 50-50, broadly, between our retail and the non-retail part. So I think we will probably grow another 4 to 5%. So the retail this year should be targeted close to around 55% of our sales.
Okay. And on the online business, how do you see the competition playing out right now? Because what I understand is it may not be directly competing, but there are established players like Off Business, which is there, for example. Grasim is also planning to kind of go aggressive on an online platform. The details are not yet out, but yeah, they have a similar, B2B online platform. How do you see the competition in the entire online space?
I think most of the players, many have come in. I mean, many startups have come in. Many, of course, some of the established players, like you mentioned, are either partly there coming in. But what I find significant traction has not really happened. And if one would just sort of broadly compare some of the, existing e-commerce sites in building materials to ours, I can easily say that probably in the variety and the range of products, we may be amongst the best. And what we generally find as of now is the online is still look more like a catalog reference. People do a lot of reference on the online and then come offline to the store. So most of these people are also talking of what can they do on the offline space. So I think ultimately in the building materials space, an online plus an offline, what we call as an omni-channel, is what is really probably at this stage looking like a win-win combo. So because even if you look at the international markets and even the Western countries, where there has not been significant growth in the building materials sector linked with the online platforms. So I think it will take a little time. So right now, too early days to comment on the competition.
Perfect. Thank you so much. Thank you.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Hello.
Go ahead, Arpit.
Yeah, I just wanted to understand our strategy on retail channel and enterprise. What kind of growth they are charging on the three channels, and what kind of working capital requirements we have for all the three channels.
Can you repeat the question again?
Yeah, we have retail channel and enterprise. So what is the strategy on three of the segments? How do we look to scale up these three segments, and what kind of working capital requirements we have for all the three segments?
So retail, the working capital requirement will be approximately around 1 month working capital required, because that is plus inventory. Around 25 to 30 days working capital required. Okay. Whereas in channel and enterprise, it will be between around 45,
Sorry, I missed it. Hello.
Approximately for retail, we are looking for a working capital of around 20 days, and channel enterprise approximately around 40 days, which will average it out to around 30 days in the working capital we are looking at.
Got it. So the 30 days which is reached for the first time in a very long period of time. So this is the kind of mix that we're going to maintain, where 25 days would be on retail and 40 days on channel and enterprise.
Yes.
Got it. So what would be your FY23? What would be a volume growth number for the whole company? Because we have grown stupendously this year in FY23. So what would be our volume growth?
It's coming around 70% with the volume growth.
70?
70, yes.
Got it. And we're targeting around 25% growth for FY24.
Correct.
And our current ROC is around 15%, and our working capital is already reduced to, let's say, 31 days. So what other measures we would require for us, so for the ROC to move to, let's say, 30% or so?
Better margin. So we are focusing on better margin in this financial year, and retain the same number of days of working capital. Really, it will help us to improve the ROC.
So are you seeing any margin expansion for FY24? Let's say added this point or something like that.
Sorry?
Are we seeing any kind of margin expansion?
To improve the margin.
We are looking
Sorry to interrupt you, but your audio is not clear.
Sorry, my audio?
Yes. Now it's fine.
Is it better? Yeah. We are certainly looking at a margin expansion. As my colleague here said, I think the way to improve the ROC is now currently, we have at least in mind a target figure of 20. We have moved from 10 to 15. So we have a target figure of 20 this year. And we believe that on the back of an expansion of margin is where the ROC should start improving.
Got it. And the warrants funding which we were supposed to receive from the EPL Apollo Group, is there some amount which is pending, or we have received everything?
No, the warrants have to be subscribed, yes. We have some time. We have till about November for the subscription to happen.
So about what percentage of money is pending which needs to be sent to the company?
25% of the money has come, so 75% is pending.
Around 70-80 crores. So we would use this money to retire the debt?
Around 80 crores.
Yeah, we would use this money to retire the debt?
Yeah, once the money comes, we will retire the debt or use for the...
Got it. So let's now...
Sorry to interrupt you. Arpit, I'll request to join the queue for a follow-up question. Thank you. The next question is from the line of Aman Agarwal from Equirus Securities. Please go ahead.
Yeah, thank you for the opportunity. So you said about the volume through APL channel was around 2.4 lakh tons for FY23. What was the number for FY22, sir?
This is for 2.4 we told that Apollo volume. It was around 90.
So it was around 1.2. We have almost doubled, you can say, from the previous year.
Okay. Okay, great. And so second, you said you expect similar kind of numbers for FY24. So just a couple of pointers relating to this. One, how's the traction for the newer products that they have launched to Raipur plant? How's the traction coming in for those products? And since this will be an addition to the existing product catalog, wouldn't the traction take the overall number higher in FY24?
24, yes. The newer product, basically the color coated is one of the significant additions that Apollo has made in towards the end of the last year, and it will significantly increase in the coming year. Yes, looking at it, I mean, when we look at a total basket of products, whether it is steel tube or color coated, I think broadly we are looking at these newer products, maybe another 10% growth on the volume over there.
Okay. And it's been some 6-7 months that the product launch has occurred for them. So how's the traction coming in these 6 months?
It is picking up quite well.
Okay. And so lastly, if I understand right, there is an existing market for the color coated products. So do you deal in the products of other companies too?
In color coated products?
Yeah.
We do buy. We are a significant customer to AMNS.
Okay. So
we do buy substantial quantity from AMNS, from JSW.
Okay. And how does the pricing compare for APL versus JSW?
See, there are multiple grades in color coated. So you've got various kind of grades. So JSW has a much more comprehensive range of products, and Apollo has as of now, a slightly more limited range of products in the range, the coating, the thickness, etc. So they compare very favorable in the comparable grade.
Okay. Largely similar, you're saying?
No, it would be a little cheaper.
Okay, APL would be a little cheaper. And just lastly, what would be the right to win for APL in this category, since there are large names already present in this segment?
I didn't get what is their category?
What would be the right to win in this segment for APL?
Right to
win, or what can take their acceptability higher, since there are already big names present in color coated segment?
Okay. One, I think good Apollo is focused on certain thicker thicknesses in color coated, which not many of the other the big manufacturers really make. So that's a product that can find a lot of new acceptances, new usages. Second, I think they've also got a very controlled kind of a capacity in this. So it's not like they are coming out with a humongous volume to compete with the other big brands. So I think they have a limited volume. They've got certain USPs in terms of the higher thicknesses. And thirdly, the Apollo brand name is very well established at using the tube at a very widespread level to smaller towns, districts throughout the country. So I think they reach much faster in terms of delivery, etc. So I think the flexibility of APL Apollo is certainly a very good USP with which they can, comfortably, what you use the word, the winnability for them, I think could be the factors.
Got it, sir. This was really helpful. Thank you, sir.
Thank you. Next question is from the line of Aman Soni from Prudent Equity. Please go ahead.
Yeah. So, sir, you mentioned previously that you are, planning to do similar or around 2.4 lakh tons of volume in, FY24 as well. So, but you're targeting for, 30%, top line growth. So, will this be basically like, are you, planning to do, high margin products, or is there anything else?
Definitely out of that 25 to 30% growth, there will be a contribution in non-steel. We want to take it further up. So if we are looking at least another, let's say, a few percentage points over there, so that is one area which will contribute to some growth. Second point is we're also looking at, in the steel area, there are so many other products. Earlier we were just talking about color coaters, we are talking about some of the other flat products, etc., which is an area definitely we're looking for at higher growth. With APL Apollo, broadly what I mentioned is only steel tubes. So we also are expanding beyond that horizon.
Thank you. So the line for the participant dropped. We move on to the next question. Next question is from the line of Shreya J. from Swan Investments. Please go ahead.
Hello, can you hear me?
Yes, we can.
Yes, sure.
So my first question is, you just said we did about 1,600 odd crores from APL Apollo. What was this number for FY22?
So I'll just give you the number. We've done about 121,000 tons approximately in FY22.
Sir, I want to know the value.
Hello?
Value.
Value is about, you can say broadly about around 850 crores.
850 crores. Okay. And my second question is, our non-steel business has grown by about 80% from 200 to 361 crores. So I just want to understand what has changed in the business, in the sense that because your non-steel has increased, so ideally we would think that your inventory should go up, but we're seeing significant improvement in your working capital. So what is actually driving this improvement in working capital? If you can just give us some granular details on that.
Broadly, definitely we have been very, very controlled on the steel part of the business and inventory. So the non-steel, yes, definitely has gone up significantly.
Sorry to interrupt you. So your voice is not coming clear. It's coming muffled.
Hello. Now, is it better?
Sir, one moment. Participant, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. So you may repeat.
Hello.
Yes, sir. Go ahead.
Hello. Can you hear me?
Yes, sir.
Yeah. I think the premise one is that non-steel would also mean a little higher inventory, which is true. But what we have also done significantly is to keep our steel part of the inventory considerably down. I think that is where we were able to maintain the averages and bring the working capital cycle down. So, of course, it has been achieved over the 4 quarters. So it is not something that has happened overnight. We started the beginning of the year significantly higher. I think our total working capital cycle at that time was about 41 days or so, which has quarter by quarter, I think it has come down by 2-3 days till we have finally come down to about 32 days in the 4th quarter. So I think the steel part, which also still adds significantly to it's still 90% of the total business. So I think even a 10-day reduction in the steel inventory has helped us bring in the averages down.
Okay. And so just hopping again on the ROC bit, you're guiding for about 25-30% odd growth in your top line and about 1.5% improvement in your margin. And given where your working capital is right now, and I assume it's going to be the same for the next year. So don't we see, sir, your numbers should be significantly better than 20% in terms of ROC?
I would leave you to do that working.
Yes, I've done that, so that's why my question, are you being a little conservative on that?
No, I think we will still be cautious in the guidance.
Okay, sir. All right. That helps. Thank you.
Thank you. We have the line for Aman Soni reconnected. Next question is from the line of Aman Soni from Prudent Equity. Please go ahead.
Yes, hi. So basically, sorry, the call got disconnected. If you can just help me with my previous question. That was basically on the volume growth. You mentioned that volume in the upcoming financial year is going to be pretty much similar. So where is exactly that 25% growth is going to come from?
Yeah. So we are not just looking at one product. See, in the steel basket, we've got steel tubes, we have color coated, we have flat products like HR, PR sheets, we have got galvanized products, we've got GC sheets, we have angled channel longs. So there's a significant amount of steel products. So despite the fact that we might probably grow marginally only with the APL and in steel tubes, our target is to sort of plateau out in the steel tube area and focus more on the other products in the steel category. Secondly, also we are looking at, again, a fairly significant growth in the non-steel part of our portfolio, which is currently in the range of 9 to 10%. We want to, as we have given a guidance that in 4 to 5 years, we would like that to be about 25% of our total top line or the turnover. So I think every year we are calibrating at least a 3 to 4% growth in the non-steel part. So I think this is where the real growth and the top line growth will come from.
Okay, so the 2.4 lakh ton volume is just for the steel tubes only, not for the other products combined as well.
Yes.
Okay, all right. And okay, that's all. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello.
Go ahead.
Yes.
Thank you very much, sir, for the opportunity. So just a clarification in terms of margins, you said about 100 to 150 basis point improvement for FY24, right, at the EBITDA level?
We are looking at, 100 to 150. No, we are talking about 50 to 100.
50 to 100. I understood that. And in terms of key drivers, what would be 2-3 key drivers that will drive the EBITDA margin improvement? I think one of the factor you mentioned was about the non-steel business, right? Any other factor that we can think of?
This is one significant area, and we also hope to keep. The others are a little more on the internal side. That way we have to look at, other, if we are able to increase the volume substantially and the top line substantially, and if we keep a sharp eye on our internal costs, etc., that also should be able to happen, able to contribute to the bottom line.
Okay, understood. I understood that. And my second question is on your APL Apollo tubes. 40% of revenue is from that segment, right? So are we looking for more kind of diversification or to reduce the concentration risk for us?
In steel tubes, yes, we are.
So what is the strategy behind that? What is the thought process or what are we doing in that front?
As I had mentioned earlier, the steel portfolio is pretty large. So, and the most significant is being steel tube, because that's one of our legacy products. So that is an area which we are sort of not focusing too much on from a growth perspective. So we would be maintaining a status quo on the top, the volumes that we are buying with APL Apollo, or a marginal growth will be there. The focus is also going to be on the other kind of products in steel tubes, as I mentioned earlier, like color coated, could be other flat products, etc.
Okay, so ideally, if your volume at 2.4 lakh ton remains same and other business grows, automatically your share of this business will reduce, right?
Correct.
Okay, I understood. Yeah, that's it from my side, sir. Thank you very much and all the way best.
Thank you.
Thank you. Next question is from the line of Akash Mehta from Kapaz Investments. Please go ahead.
Hi, sir. Thanks for the opportunity. Just one thing, as an analyst, I just want to know that, how should one analyze the company and overall business segments? Because one, that we've moved to a marketplace model, and now your presentation states the retail and non-retail segment instead of a retail, channel, and enterprise segment. So what would be the strategy going forward?
See, we have kept, because we introduced or talked about the marketplace last year. So we have been since our inception following this sort of a presentation based on retail and the other wholesale, the channel and enterprise as one. So we wanted to keep it consistent for the whole year. So we did not want to break anything in the course of the last year. So we have continued with the same presentation up to Q4. So there is a consistency in the performance. In the coming year, definitely there is an internal talk going on. But the retail part, I think, still is a very significant part of the business. So we might continue somewhere in the same line, but we will give you maybe the presentation would change a little bit from the next quarter onwards.
Okay, so next quarter onwards we should be changing. Okay, I think that's the only thing I have. Thank you.
Thank you. Next question is from Hiten Borecha from Sequent Investments. Please go ahead.
Hello. Hello, am I audible? Yeah.
Yes, you are.
Thank you for the opportunity, sir. So I have only a couple of questions. First one is, can you give me the margin difference between steel and non-steel business?
At a gross margin level, you can talk of non-steel at around 10%, and the steel business would be around 4%.
This is the gross margin, right?
Yes.
Okay.
And we significantly grow up the business in the non-steel. Obviously, the EBITDA also, there would be a substantial difference.
Okay, understood, sir. Yeah, thank you. And so my second question is on the rental cost. So on slide number 8, you have given a rental cost was around 14 rupees per month, which has gone up to 16.8 in last 4-5 quarters. So would you like to give some comment on this? Are we going to pan out? Is it going to sustain here or anything like that?
Yeah, I think one thing is when you look at the 14.1, which was FY22, I think we had in the COVID years managed to get some compressions and discounts on the rental at that point of time. So I think that was one thing that it actually came down. The rental prior to COVID was 3 plus, and then it came down to this 14 figure, which was the rental per square foot. So then it has started steadily going up in the next 3 quarters, and like you mentioned, it's about 16.8. I would say anywhere between around 17 to 17.5, it should hold on.
17 to 17.5.
Yes.
Okay. And sir, any last question, sir, if may I? Any plans to add the retail stores, or are we going to continue with this 90 or 91 kind of number?
I think for this current year, we'll be plus or minus a couple of stores, 2-3 stores in this number.
Okay. Thank you, sir. So I'll get back in the queue for next questions. Thank you.
Thank you.
Thank you. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Hello.
Yes.
Hello. Yeah. Just wanted to understand the ROC profile between steel and non-steel business. That was my number one question. My number two question was just I wanted to understand the store economics. Let's say when you open a store, what kind of capex you require, what kind of inventory you require for these kind of stores, and what kind of throughput you have on an annualized basis. That I wanted to understand for store economics. And the third question was around the ROC profile between marketplace versus inventory-led model. So what is the difference between the two, and why are we opting for a marketplace model instead of an inventory model? And the fourth question would be around, is the promoter group ready to, sell out company or open to acquisition of Shankara to any other private equity player or an APL Apollo group, anything on that sort? Those are my 4 questions.
Oh my God, you run through them pretty fast. So let me answer your last question first. No, we are not interested in selling out or any such thing of that sort or an acquisition. No, we have no such plan in our mind now. So that is number one. Number two, I think you asked about the ROC difference between the steel and the non-steel. Am I right? That was your question one.
Yes.
Salil, would you like to answer that?
The steel for the year FY23, when we are taking the average, so steel and non-steel will be the similar line of the 15%, because in future when the non-steel revenue goes up, the expense will remain the same, the EBITDA percentage will go up. At that time, it can become around 18 to 20% for non-steel, and steel will remain at around 15 to 16%. On an average, for the year, it will be around 16 to 17% will be the overall ROC.
Because our margins are typically higher on the non-steel side, right? About 10% gross margin.
Yeah, definitely the non-steel has got a higher margin percentage, yes.
So our capital employed, let's say in terms of inventory, would not be that high compared to, let's say, because we would require a little higher inventory, but our margin would actually...
One does require high inventory, but it is not that significantly higher.
The ROC will be significantly higher for the non-steel business, right? Because
as we start kicking in the economies of scale in the non-steel, automatically you will see that the ROCs on the non-steel will pick up. Steel also has a fairly good turnaround. So as our volumes pick up, I mean, even if we remain status quo, I think the next 1 year, the real play out is going to be on improving our margin significantly, assuming all other parameters remain the same. Definitely, keeping the working capital at the same level itself will improve the ROC. However, with an improvement in the margin is what we are looking to see with the ROC really gets added significantly.
Got it. So next question on the store economics, if you can speak about.
For the store economics, if you are going for a lease property, so total capex and all together around 1.25 crores is required for 1.522 crores money is required to set up a store, for which for the getting the return on a minimum of around 1 crore of revenue has to happen with an margin of around 6 to 7% of GP if you are able to make it. Within 3 years will be the break-even period. 2 to 3 years will be the break-even period.
So would that be break-even or that would be payback?
No,
break-even would happen probably in about a year's time. And the ROC or the significant, if all goes as per plan, I think in 3 years we can recover our cost. We can.
3 years is the payback period for your stores.
Yes, it's the payback period, yeah.
And the economics between marketplace versus the inventory-led model which you're having right now.
Yeah, the marketplace, I think one of the key ideas was that to fuse this, the more of this omni-channel and the kind of, we do get a certain amount of, we have this reach with about 90 odd counters, so where we do get, a lot of, let's say, smaller wholesale inquiries, we get small project orders, we get a lot of mixed kind of customer base that come and approach a store. So that is where we thought that it makes a little more sense when we look at a store that can cater to the entire market rather than just looking at it very focusedly from the retail walk-in kind of a business. So I think that is what was broadly the expanding of taking the definition into a marketplace.
So would it be, let's say, would you call it similar to infra market, what they are doing, or be different than infra markets?
Yeah, I don't know. I'm not very conversant with the infra market model, because I don't think as of now they may have that many kind of retail offline stores. But yes, there are people like infra market, there's online, there is Zwork. And now earlier somebody was talking about the Glassing group coming in. There's JSW1. There are quite a number of people in this space for more of a marketplace. So what we would still like to look at is, yes, for want of a better definition, we've used the word marketplace. But I would still say that our retail formats continue, because that is very clear that the offline stores are very, very critical. So it's some sort of a blended case. I mean, it's still a new animal on the ground. So let's see. I mean, as we move forward, we probably can give you a much clearer definition of the same.
Thank you. Sorry to interrupt you, Arpit. Ladies and gentlemen, due to time constraint, we'll take the last question from the line of Lakshmi Narayan from Tunga Investments. Please go ahead.
Yeah, thank you so much. A couple of questions. First is in terms of your store expansion and the area expansion, right? We are around 90 stores. We just want to understand how are you looking at in the next, 2 to 3 years. And second, in terms of the number of brands that are actually getting onboarded for the last year, how much of sales have actually, incremental sales have actually come from new brands that are actually new logos which we actually added?
Yeah. In terms of the first question, the store expansion, we are not looking, as I've answered this question earlier, a significant expansion in terms of store growth. There would be probably a couple of stores. So I would say plus minus kind of 2-3 stores will happen in the coming year. So we are not looking at significant store expansion in the near future, number one. Number two, coming to the new brands, a lot of new brands were onboarded in the last 6 months. We have probably, mostly it is in the non-steel arena. So in where we have onboarded significant number of new brands. So today I would say from the non-steel part, they contribute probably just to about 10 to 15% of the top line. But some of these brands are very, very significant, and we see quite a rapid traction happening in the coming year.
Right. And last question, in terms of your free cash flows, right? So what do you intend? Can we maintain the similar kind of cash flows for the next year, or how are you?
Yes, we can be a little. There can be improvement in the cash flow. We are expecting better net cash generated from the operating activities.
Okay, and what is your plan of cash flow you'll be reinvesting in the business? Like how do you think about it?
Yeah, the fund will be reinvested for the company for capex we'll be using, and rate of interest also we'll be using it.
So I mean, it augments our own working capital.
Okay, and in terms of capex, what is the guidance for the coming year?
Approximately around 25 crores.
Sorry?
25 crores.
Okay. Thank you so much.
Thank you. I now hand the conference over to Mr. Sukumar Srinivas for closing comments.
Yeah. I thank you everyone for taking time off your busy schedules and a working day and to attend the conference call today. So thank you so much. In case you have any further questions or queries, request you to either approach us or talk to our Investor Relations Associate, SGA. Thank you very much. Goodbye.
Thank you very much. On behalf of Shankara Building Products Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.